Good morning, ladies and gentlemen. I am Vittorio San Giorgio. I'm responsible for investment solutions at 12 Capital, and I'm very happy to welcome you today on behalf of 12 Capital to the webinar that is going to cover a very interesting part of fixed income. We're going to go through the market risk, historical performance, and opportunities that is offered by insurance debt. Today, joining me in this webinar is my colleague Dinesh Pawar. He's head of insurance debt at 12 Capital, as well as my colleague Baptiste Champavert, who's a part of the credit and equity analytical team. Without further ado, let me briefly introduce the topic of today. So we're talking about fixed income, and within fixed income, we're talking about insurance debt. Insurance debt is an asset class which makes roughly 175 billion, so it's deep and investable. And most importantly, the issuers of insurance debt are defensive, highly capitalized and regulated companies. It offers a good diversification in a traditional fixed income portfolio, and most importantly has recorded attractive risk-adjusted returns over the past years and provides a premium compared to other sectors in fixed income. I leave on the presentation to my colleague Dinesh, who's going to drive you through the details of the sector and the comparison between other parts of fixed income.
Thank you, Vittorio, and good morning, everybody. Starting off, really, what we believe that an overweight solely to the insurance bonds universe offers a far superior return over the long term versus comparable investments within credit. What we see from the table there, or on the line as you can see here, is that there's a significantly higher spread from the insurance sector, which we at 12 define as a complexity premium, which in itself has created a positive barrier to entry. What we note is that this higher return is not to the detriment of credit risk, rating risk, or default risk. There is a slightly higher market volatility attributed to the sector, which in our view is explained by the complexity and the lack of understanding within the insurance sector, and creates many opportunities for sophisticated investors or those who have really spent time to understand the underlying risks. It's typically short term, not structural, driven by the dealer market when we have spreads widening. It's something that we've seen from time to time in all parts of the credit market. However, our long-term view is that volatility of the past is somewhat diminishing or slowly becoming uncorrelated to broader sell-offs. For example, in the recent severe volatility, especially driven by the banking sector in 2023, you may recall when Credit Suisse wrote down their bank AT1 structures, or many of the regional banks in the US began to fail. The insurance sector was broadly unaffected. While some segments of the financial indices were down in excess of 10% or more, the insurance sector was relatively stable.
Dinesh, thank you. There's already a question coming up from the audience. People are asking, is the higher volatility of the sector a reflection of higher risks or hidden risk within the sector?
It's a good question. And I think what investors need to understand or get their mind around, and I'll quickly go back to the slide that we just previously had on screen. No, the answer is simply no. Credit market volatility, as we've seen in the past few years, has been a combination of real macro drivers. We've not seen any specific risk to the insurance sector. We've not seen defaults. We've not seen migration risk in terms of rating, and neither have we seen earnings at a detriment to any kind of weather or hurricane risk. So I think the reality is that what we've seen is very acute market volatility, whether it was driven by COVID or whether it was driven by, for example, as I already mentioned, the banking crisis. These seem to be the things that drive volatility. And what we say is that given the long-term nature of investment within the insurance sector, those types of volatility should be used as a source of investment or taken advantage of.
So maybe to add a bit more color on what Vittorio said on the introduction slide and where we are focusing on the European subordinated market. First of all, if you take the global insurance space, which is roughly in euro 750 billion, Europe is the biggest market for subordinated debt. It is roughly 50% of the total subordinated market, and the rest being equally split between North America and Asia. The reason why we see more subordinated debt in Europe is because typically insurance companies need this type of capital to support their solvency ratio. Then the second explanation is, as Vittorio mentioned before, sub-debt is where we see the most attractive risk-adjusted returns. Right now, if you take Tier 2, In euro, they return roughly 4.7% yield, while RT1 structure, which are more junior structures, offer an extra 200 basis points on top of this. Then, from a regulatory standpoint, the framework is more straightforward in Europe with Solvency II that has brought a lot of transparency to the sector. If you look at the US market, it's a bit more complex and rules can differ by state. Finally, I would highlight the interest rate risk or the duration risk, which is limited in our view. Most of the outstanding debt is dated, more than 75%, with coupons that are fixed to floating. This means that coupons are fixed for a certain period, typically 5 or 10 years, and then they reset, reflecting the new risk-free rates at that time. This reduces materially the duration of the bonds. So to summarize things on this slide, the European insurance subordinated sector represents today roughly 70 issuers, 300 issues, 175 billion debt outstanding, main markets being France, UK, and Germany, where typically we see the highest number of insurance companies, but also the biggest insurers in size. Having said that, we also see debt issued by what we call the national champions within their own markets. Think of NN in the Netherlands, typically, or AGEAS in Belgium.
Like any market, the growth of the market is extremely important for investors to be able to get diversification and continue to have a strategy that pays over the long term. Insurance bonds have grown significantly over the past 12 years, attracting a specialized yet deep investor base who seek the comfort of a reliable coupon, attractive yields, offering total diversification away from traditional business models such as banks or consumer cyclical sectors. This growth has shaped or was shaped by the GFC, the global financial crisis, which kicked off in 2008, and more importantly, the advent of Solvency II, and continues to influence both how issuers and the investors use or approach the insurance bond market. For issuers, the advent of Solvency II meant the movement from mark to book to mark-to-market accounting and led to new forms of standardized reporting and standardized issuance to comply with Solvency II requirements. For us, investors, the growth has created extremely many opportunities, both within Tier 2 and new forms of restricted Tier 1, which offer exceptionally high yields for very low default risk and very high ratings. More transparency and greater certainty with the adherence of rules under Solvency II has led to an extremely dynamic market and extremely liquid and deep in terms of bond issuance and bonds being called. As we further draw nearer to the end of Solvency II, the grandfathering period, as you can see on this table here or this chart, the 2026 period is going to become exceptionally important. Issuers can no longer rely on legacy instruments that were issued pre the Solvency II period or pre-2016 as part of their regulatory stack, and therefore we see a strong incentive for those insurers to call those existing bonds and refinance them with new compliant existing subordinated debt. This uplift creates a potential new set of insurances coming through in the next 2 years. So we feel very positive about this and think there'll be exceptionally many opportunities for investors to get exposure to the market.
2024 has been a very active year in terms of new issuances and tenders, following 2022 and 2023, which had been more subdued. A couple of reasons again for this: issuers being less pressured to issue debt, solvency ratio improving a lot thanks to higher interest rates, refinancing costs were higher, again because of the higher interest rates, and there were not many bonds maturing in these years. We have seen year-to-date close to 12 billion euro of new issuances, which is basically equivalent to the full amount issued in 2023. In terms of net new supply, the amount is above 4 billion euro, and we expect this amount to remain positive for the rest of the year. On spreads, despite a material tightening year-to-date that we have actually witnessed in the broad corporate sectors, the spreads at issuance for insurance subordinated remained well above 200 basis points, which is again reflective of the insurance complexity premium that Dinesh introduced before. And this is despite new issues being materially oversubscribed, with a lot of new participants coming to this usually less crowded sector. We also see proactive capital management from issuers with more tenders compared to other sectors and higher tender premium, which makes the sector even more attractive.
As you can see from the following charts, the sector is dominated by multinational champions spread out across a broad geography. Along the top, you can see Allianz, AXA, and Generali are some of the key dominant issuers within the European space. And further down the chart, we see national champions such as Aviva, Legal General, Crédit Agricole, and NN. In addition, we've seen the emergence of market specialists within the sector, leaders still within their own right, such as Rothsay and PIC, which have been benefiting from issuing bonds given the growth of the defined benefit pension market in the UK. The sector is also dominated significantly, especially in Solvency II, by European issuances, 60%, but still we have almost 40% exposure split between sterling and US dollars. In US dollars, the main issuers tend to be Allianz, Swiss Re, and Zurich. Even AXA as well has a strong participation program in that space. The sector is essentially comprised of investment-grade securities, and I think that's a really important point to make here. With less than 5% of the investable universe below investment grade, so what we argue is that the insurance sector is a well-balanced A to BBB in terms of corporate credit ratings. Overall, investors should draw comfort from this diverse range of strong issuers, all highly rated, offering different levels of diversification within their own specialist fields.
Following up on the previous slide, on this one, we plot the Tier 2 bonds issued by European insurers with yields on the y-axis and credit ratings on the x-axis. What we see here is that the blue chip names or the global multi-line names that Dinesh mentioned in the previous slide have the highest rating, so they sit on the left-hand side of the graph, but they also return the lowest yields. These names have become, in general, well-known and well-covered by the markets, meaning that generalist investors can rely on more research. Still, what we see in these names is they return a higher spread compared to other big corporates. Take an example, Allianz Tier 2, which currently returns an extra 1% extra yield compared to an equivalent rated bond issued by Total, the French energy company. Having said that, where we believe investors need expertise is on names that sit on the more gray zone, which is on the right-hand side of the graph. These are names which are still very well rated, still very much investment grade, but names who are less covered and who require more attention. This is where most of the complexity premium sits in our view. Again, a couple of factors explaining this in our view. One is some of them are not listed players, so they are not covered by equity investors. Other are just smaller in size compared to the big blue chip names. They can also be more specialized, less diversified than the big multi-lines. Think of Direct Line, Motor UK, operating on the Motor UK business, or Click on the life BPA market. And finally, the last reason, in our view, is they might just be less frequent issuers of debt.
Thank you, Baptiste. One of the things, or one of the arguments that we constantly see is, or traditional investors believe, that higher yields traditionally mean higher default rates or more risk. And the following slide actually counters that argument quite well. High yields, strong ratings, and a sector that operates under strict or stringent regulation from its various regulators doesn't necessarily mean that they have higher defaults. In fact, the insurance sector has one of the lowest default rates than any other sector that investors can invest in. And this is really important because it provides a great sense of reassurance that the sector has operated prudently if you consider as a kind of volatility or the events that have happened in the past 20 years, all the way from the global financial crisis, all the way through to the European crisis. What we see is that the insurance sector has managed its way through very robustly in all of these crises and has had hardly any defaults. And actually, even in recent times, if we've seen the banking crisis, as I mentioned previously, the insurance sector weathered that storm exceptionally well.
I see a question from the audience, guys. Could you maybe remind us if there's any notable default in the subordinated debt space in Europe or in the areas that you typically look at?
Yeah, it's a good question. Going back and casting my memory to the European sovereign crisis, there was a French insurance company called Groupama who actually missed a coupon, and that was really actually a non-event back then, and this is going back almost 14 years, and it had no or little impact. So in terms of where the defaults are happening, what we find is that the blue chip names or the mainstream names that we invest in are relatively immune to this because of the stringent regulation that they operate in. We are aware, though, however, there are some very small emerging market insurance companies who may have had struggles, but that's actually very minimal and it doesn't impact our market at all.
On this graph, let me first explain a bit the axis. On the left axis, you have the dark blue line, which represents the average credit rating of the insurance sector from 2000 to today. On the right axis, you have the light blue bars representing the proportion of insurance companies being rated by at least one of the three major rating agencies, S&P, Moody's, and Fitch. So what we see in this graph, starting with the right axis and the light blue bars, is that the number of companies being rated has significantly increased over the past 20 years. This means investors can rely now on more coverage today compared to 20 years ago. In the early 2000s, you only had a few major names being rated, and they were rated at a very high level in the AA area. Just to give you an example, this is the same level France is currently rated today. The sample of rated companies at that time included the four major insurers, Munich, Swiss, Hanover, and SCOR, and the big multi-line players such as Allianz, AXA, and Generali. Now, if we focus on the dark blue line, we see a significant impact from the major crisis that we had in the first 10 to 15 years of the century. First, we have the aftermath of the 9/11 attack, which had a material impact on the economy and in particular on the reinsurers. Then we had the Grand Financial Crisis in 2007-2008, followed by the European debt crisis in 2011-2012. Again, what is important to bear in mind, and what Dinesh said, is that during this crisis, there has not been any proper technical default apart from Groupama missing coupon on a tier 1 security. Then moving on, we put Solvency II preparation, which is not a crisis, but a material regulatory change that led the sector and investors to adapt to a new set of disclosure. Interestingly, we noticed that since the implementation of Solvency II, there has been a steady improvement of credit ratings. This is reflective, in our view, of the higher regulation, better transparency, and solvency ratios improving over the years for the overall sector. Finally, we have actually seen very little impact from the recent two crises, take COVID and the Ukraine conflict, where insurance companies remain very resilient despite, one, the excess mortality for COVID, and second, all the consequences of the Ukraine conflict, inflation, insurance coverage on very specific lines of business, and the shutdown of Russian operations.
Insurance debt has historically traded at higher spreads relative to other sectors. And one of the things that we notice, this spread continues to be the case. When we look at the following chart, you can see by the blue line, which represents European insurance subordinated debt, what we've done here is done a time series of data going back all the way to 2011 and compared the lighter blue line, which is an equivalent rated European corporate debt index. Now, clearly, one can see the different direction that things have taken, and you can see the correlation between the two. However, what is very clear is that this spread premium, and we've mentioned this already, or we termed it the complexity premium, still seems to pay more than what one is achieving within the European corporate space. And that comes down to a number of reasons. Clearly, what we can see here in 2016, the spread premium was much higher, and that was because we were having the Solvency II preparation, and we saw investors very much in a wait wait-and-see mode. It was a new form of regulation, and it was the first time insurers were going to actually report their Solvency II ratios. The spreads were slightly higher, but at the same time, that was combined with new issuance of the sector. Also, we saw spreads widen out to kind of a more recent peak in February 18 and 19, and this was really driven by the China standoff or trade standoff with Europe and the US. And then more recently, we saw the spikes within COVID in March 2020. And then in 2022, we saw the advent of inflation and the move by central banks to tackle that inflation with higher interest rates. What's very, very clear, though, from this is that we believe that insurance subordinated debt from a fundamental perspective is better both on a quantum and quality basis when you compare it to European corporate bonds. And therefore, we've maintained our view that insurance bonds should trade inside corporate bonds. The other thing which I'd like to bring to your attention is the fact that looking at the average rating, most parts of credit these days have become overcrowded, whether it's banks, corporate indices or high yield. And what we say within the insurance space, it's one of the few bastions left where one investor can achieve a meaningful spread premium relative to corporates or whether it's high yield as well. And moving on, really what we can see here on the following slide is the historical returns of insurance bonds relative to those very similar European corporate bonds. And what's really important, and what we say time and time again to our investor base, is that holding insurance bonds over the long time mitigates that volatility that we mentioned at the very beginning of this slide. And really, in fact, what one can see is that holding insurance bonds over a longer time period almost doubles the kind of performance return that one can expect from this strategy. And so really, 12 has used market volatility or dislocation to really actually navigate their way through investing in insurance bonds, which have been materially mispriced by the market simply due to a misunderstanding or a misplacement of the risk and underlying fundamentals.
Dinesh, I received just a quick question around performance and spreads. What we're seeing these days with an increased volatility due to the elections in France and the questions around the elections in the US, have you seen anything impacting the insurance sector?
The answer is no. What we have seen, though, well, first of all, let's tackle the question in two aspects. Do we think that the insurance sector will be impacted by French elections? We say no. I mean, the sector is very immune. It's very long-term. You know, insurance companies invest for the longer term. They know their liabilities up front. They're not driven by mark-to-market risk. You know, unlike a bank, which has very strict CET1 ratios to adhere to. You know, if there is a big market crisis, they may be forced to sell down securities. That's simply not the case in the insurance sector. I think that the risk really posed by what's going in France has really been reflected in the government bond yields of the French government. And in fact, we've seen a greater degree of volatility within French banks. With respect to the upcoming election at the end of this year, I think what we've seen in the past in 2016 is a general market sell-off when Donald Trump was elected. Now we kind of know what a Donald Trump government would look like or what it's going to mean. And I think the sector is actually fairly immune to that. So I think the reality is these kind of big geopolitical movements that we're seeing are actually well contained within the insurance sector. That's not to say that we may see some spread widening, but actually we would say that's really more in sympathy with the broader spread movement in spread risk. Hopefully that answers the question. The following thing is very important on the following slide in terms of how we approach it. Now, clearly, there's two aspects, systemic or idiosyncratic. I'll cover systemic first of all. There are classical synergies between what we see in a traditional credit portfolio and what we see in terms of what we look at credit risk or credit risk mitigation strategies within investing in insurance bonds. Now, credit default and migration risk, migration meaning rating risk, is actually as a non-event within the insurance sector. We've already proven the fact that the insurance sector has one of the lowest default rates than any other sector. And in fact, migration risk is completely the opposite. In fact, what we see consistently is insurance companies their ratings being upgraded. Liquidity and interest rate risk are probably the two key topics here, which I'd briefly like to discuss. Liquidity is important simply because it's a measurement in terms of how frequently, first of all, investors can trade in and out of a security. And that comes two-handed. On the first hand, we have investment banks or syndicate desks who have very, very strong relationships with insurance companies, and for the past 10 to 15 years have proven time and time again to have very good placement programs within the broader market. What we've definitely seen, though, is the fact that the number of traders or market makers who are offering secondary market liquidity has certainly picked up, and we think that will continue to be the case going forward, because as we get into the higher new issuance volume, as I've already mentioned some slides back, into 24 and into 26, as the end of the grandfathering period comes to a conclusion and we see new forms of debt emerging, I think there'll be much more coverage and more trading activity, and that can only be a positive. Secondly, and one final comment on liquidity, issue sizes tend to range from 200 million to 1.5 billion upwards, and those are for the 1.5 billion being some of the big A-rated insurance companies like the Munich Re's, the Allianzes and Axis. So there's plenty of liquidity. From an interest rate exposure, I think one of the most important things to mention is that insurance companies offer different types of debt, whether it's bullet structures or dated instruments. And that's really important, simply because those instruments give relative comfort in terms of the direction of travel. Also, one of the things that we found in the past few years, that short call structures of bonds that are going to be liability managed out are extremely attractive and help to mitigate that kind of exposure to duration or interest rate risk.
Then on idiosyncratic risk, these are typically risks reflect insurance companies face. You have cat risk, typically think of the big hurricane in the US or earthquakes. You have lapses, policyholders withdrawing their funds from their insurance policy. You have biometric risk, like the excess mortality witnessed during COVID. And finally, asset risk. One thing very important first to mention is that this asset class is way less impacted by each one of these risks individually than other asset class such as ILS, cat bonds, for example, or even equity. Still, there can be some spread widening at times, and therefore to mitigate this, we tend to target companies that are generally well diversified, generate more easily capital in the sense of improving solvency ratio, and are also less impacted by lapses. Typically bank insurance players having a better control on their distribution of their products, or players that have a broader client base and not only focus on, for example, sophisticated policyholders.
Thank you, Baptiste. And finally, really, what's our 12-month?
And maybe Dinesh, sorry, just before you dive into the bit of the outlook, I also got a question that asks around what the implication of a different rate outlook will be on the sector and the opportunities for the next month. So maybe you can incorporate this in your final slide.
Yeah, sure. Thank you, Vittorio. So really, we need to come up with a view in terms of what we're thinking. And really, there's three scenarios that we look at the insurance sector, and all of this based on our track record. A bull case scenario, really in the past, we've seen bull case scenarios driven by growth, interest rate cuts, significant interest rate cuts, and spread contribution. We don't think there's going to be a bull case generally in the broader credit markets. 2024 started with spreads that are very low in the general credit world, and we don't think central banks are in a major rate cutting scenario, given that inflation is still seeming to be bubbling away in various economies, and so therefore we don't think the bull case is something which is very likely to happen this year. On the bear case, similarly, we don't think that central banks are prepared to actually drop the economy. We think that really actually there is no significant market risk other than the geopolitical risk that is coming by. But actually, as we saw in 2023, there seems to be a lot of cash on the sidelines parked up in money market funds, and we're still waiting for that flow of money to come back into the market. Our central base case scenario is actually what are you achieving in this strategy, or we're looking at fixed income in general in insurance bonds, is a yield contribution somewhere in the region of 425 basis points. And we think that the spread contribution, which is a combination of existing bonds tightening in or new issue premiums that we've seen, as Baptiste already mentioned a few slides ago, still looks healthy and still looks sensible. And that's really important. The sensibility of this sector is extremely vital when issuers are coming to the market, so anywhere between 100 and 200 basis points. So realistically, I think the total expected return one could achieve by investing in a broad range of insurance bonds is between 5.25% and 6.25%. Now, coming to your question, if the rate environment changes, I'm assuming if the rate environment changes for interest rate cuts to emerge, I think the reality of it is that there still needs to be a huge wall of capital that's trying to find a yield. If interest rates do begin to get cut, then I think naturally one would expect duration or the purchase of duration would be a better way to position yourself. And for the insurance sector, it's actually quite well posed for that, because if you think about the fact that in the next 2 years we're having a wave of new issues coming through, the best way to probably incorporate that when you're thinking about buying duration would be adding new duration into your portfolio, and that can be done through the new issues that we're seeing coming up, which are giving a much higher spread duration, and therefore ultimately a better return.
Thank you very much, Dinesh. Very clear. I would remind our listeners, if there's any last questions you'd like to ask, please do so. Otherwise, thank you very much for those who intervened during the presentation. I would like to conclude by reminding the attractiveness of the sector. Again, we're talking about a sector which offers attractive returns and a positive outlook for the months to come and for the years to come, and it has proven to deliver spreads and performance which are above similarly rated indices in Europe. The other important thing is that I would like to remember about is 12 Capital. 12 Capital is an asset manager with a wide series of investment strategies focused around insurance. We manage around 800 million in insurance debt and a total of 5 billion in assets across the different formats and strategies. If you'd like to ask any further question, or if you'd like to have a more in-depth view of our offering, please do not hesitate, and there is a slide which shows some of our contacts just after. Please feel free to just contact one of our sales representatives or reach out directly to us. Thank you very much for your attention today, and thank you very much for my fellow panelists for their presentation. And I wish you a fantastic continuation of the day and the week.